What's up everyone, Dylan here. I wanted to hop on for another episode of the weekly analysis video, so with that said, we'll hop right into it. There's been a lot of chatter about a government shutdown, so I wanted to touch on that before we move forward. So as of this moment, as per Polymarket, there's a 94% chance that the US government will shut down. That will happen tonight at midnight is technically the cutoff. Okay, so what does that mean? The best explanation that I've seen is from Adam Crisafulli. So I wrote this last night, or literally copy and pasted it last night. Um, Feel free to pause this video and read this, but the most important part in terms of how it affects the market, right? What implications does it have on the market? And that's where I bolded. Basically, it says that markets have been expecting a shutdown and will tolerate one so long as it doesn't extend beyond 2 weeks, right? Anything beyond about 14 days will leave investors and the Fed flying blind when it comes to critical data at a time when the economy is going through multiple inflection points. So, again, in other words, as long as it lasts less than 14 days, it shouldn't have much of an effect. In fact, BBG came out and said, quote unquote, during previous shutdowns since 1981, stocks and bonds have actually had positive returns, whereas the dollar tends to be negative. Okay, and the reason this matters is because it affects um, different catalysts, right? Different economic events. So this week, the main event was supposed to be on Friday at 8:30 a.m., being the jobs report. However, if the government shuts down tonight at midnight Eastern time and it continues for the remainder of the week, we will not have that jobs report. So it is very important to be aware of what the government shutdown will change, right? So here's an image from Bloomberg. It said, some key economic data at risk of delay, reports likely to be affected by a government shutdown. And you could see, again, you could pause this, take a screenshot, whatever you want to do, but you could see the monthly jobs report, which was supposed to be scheduled for October 3rd, this Friday, and that will be affected. Okay, so that's that. Again, it should not have any effect in terms of negatively speaking, unless it extends for more than 2 weeks. Okay, so nothing really to worry about there at the moment, per se. Okay, so what's been going on? I wanted to talk about what we saw last week. There was actually a very bullish pattern that came about on Thursday that I wanted to go over. Okay, and you guys know that I was leaning on the bearish side, even though I told you last week that my personal thesis became invalid on Monday. I was still kind of leaning bearish, and we did get somewhat of a downside drop from Tuesday to Thursday as price came down. At the climax, it came down about 2%. Okay. However, on Thursday, there was a very, very bullish pattern that doesn't happen often that I touched upon in the Discord, and I wanted to talk about it here. Okay, so what that pattern is a positive divergence. Okay, what do I mean by that? Okay, this is what it is. Basically, you're using the reference point as the intraday low. Okay, the intraday low is your reference point. So let's go ahead. I'll do a 15-minute chart so you could see this easier. Okay, so we're looking at Thursday. Okay, so essentially what happened was the S&P came down in the morning, right around 9:30 upon the opening bell, and made a low. Okay, so what we're gonna do is we're gonna highlight that low. Okay, later on in the session, it ended up breaching below that low. Okay, so it broke below that low. However, using that same exact reference point, that early morning low on Thursday, the Nasdaq made a higher low. So the S&P made a lower low, whereas the Nasdaq made a higher low. Okay, so that in itself is still it's not enough information for me. Okay, the added ingredient, which makes it very, very important, is the VIX. So the VIX futures, using those same exact reference points, we have the high of the early morning from Thursday on the VIX was at 18.7, okay? What should have happened when the S&P broke below that intraday low with some it had some aggression involved, some momentum. What should have happened was that the VIX should have taken out that high. Okay, so anytime the S&P breaches lows with momentum, okay, the VIX should be at or above that same reference point high, okay, or vice versa. It works way better to the downside. So in this case, this is a perfect example, okay? So the fact that not only the NASDAQ was making a higher low, but also the VIX was making a lower high, that was two pieces of divergence. What does that mean? Okay, I talked about it in the Discord right here. Right? So, this is what I said. 18.6 in VIX remains key, right? Major negative divergence in the VIX, right? We see ES dropping 48 handles since Tuesday's low when VIX was trading 18.6. Yet, despite the downside pressure in ES, VIX has yet to overcome that level, right? 18.6. I'm going to get into that. Okay, this is not a good sign for bears. It implies that smart money is not hedging for continuous downside pressure. It also implies that areas of support have a higher probability of holding. Okay, so as long as VIX continues to fail at that 18.6 level, bulls have the advantage. Okay, so let's go ahead and draw 18.6, right? You can see that was Tuesday's high. Okay, and for the next few days, it continued to fail there, which gave the S&P bulls the advantage, okay? So not only that, but we also had this divergence here where despite the S&P breaching that low, the VIX was unable to break above that high, okay? And again, what did that imply? That implied that the downside pressure below that reference point low would be short-lived, okay? So essentially with this pattern, the way to play it is you wait for the S&P to recapture that low, and then you would ideally take the NASDAQ long, which is the relatively stronger name, okay? I didn't do that. Instead, I shorted the VIX. I shorted the VIX at 18.55 and got a very, very nice short to the downside, which ultimately got all the way down to the contract lows, right? If I zoom out, you can see the lowest this thing has been 17.25. So I shorted 18.55 and got a really, really nice move to the downside, only on 20 cents worth of risk. My risk was above that high, so I was using 18.75. So 18.55 to 18.75, about 20 cents of risk, and was able to get a nice move. But that's besides the point. What I'm talking about right now is the fact that that pattern single-handedly, in my opinion, obviously there's many other factors that move the market, but that single ingredient was the telltale sign that the bears were running out of steam last week. Okay, the fact that despite the S&P dropping 70 handles since Tuesday's low, right? We go here. Since Tuesday's low right here, you do a measured move, it dropped 70 handles to Thursday's low, right? 78 handles, yet the VIX was unable to break above 18.6 and sustain value. And then later on Thursday also gave you a clear divergence of the fact that it was not able to take out that early morning high. So with the VIX weakness, I viewed that as being bullish the S&P, okay? And since then, the market has been very, very strong. So again, I'm not telling you this information to boast my trade that I got short the VIX. I'm telling you this information so that going forward, you can self-sufficiently see these patterns and utilize them on your own, to come up with actionable trade ideas. Okay, so down here, I started to get bullish the S&P, at least for near term, because of that positive divergence. Okay, So let's talk about what I'm expecting going forward, okay? The S&P and the NASDAQ got very, very close to all-time highs. As of today's close, today was the last day of the quarter. So upon the market on close order, right, I posted in here, if we go back down, right, I posted this morning, I said, the last day of the quarter, so the last 10 minutes of the day, can see a quick tape when the MOC order gets released to the public. And that ended up being over $4 billion to buy, which gave the market a nice boost in the last 10 to 15 minutes. Okay, so with that boost, the S&P only got about 13 handles away from the all-time high, whereas the NASDAQ has been showing a little bit more weakness as it hasn't even taken out yesterday's high. But without a doubt, no argument that both indices remain very, very close to all-time highs, okay? So what I was talking about on Thursday night's webinar with the Academy members, I talked about if and when the S&P does move to the downside, which, you know, who knows if that's going to happen to this degree. I'm just going to draw the line regardless. I was talking about if and when the S&P did come down here, right, I was looking to incrementally buy about 5 to 10 stocks for a year-end rally, okay? So I told them some of the stocks, and I said, if and when the S&P gets down there, I will tell you guys the several stocks that I am looking to incrementally buy for that year-end rally. Okay, so I still am going to do that if and when it gets down there. Okay, so why am I saying that? Okay, there's a few reasons as to what points to the fact that the next 2 months, right? Ideally, I want to see the S&P come down there into, say, mid to the second or the third week of October. Then I would love to get the opportunity to buy that dip for that year-end rally. So I wanted to talk about some of the reasons as to why that would be a solid setup. Okay, we have some pictures here. Let me see. Screenshots. Okay. So, first off, we have this. Okay, this is since 1928, as per Bloomberg, right, compiled by Citadel Securities. You could see that the market, from a pure seasonality standpoint, tends to bottom in the start to the third week of October, where then the market tends to rally very, very nicely. So, as per this image, you could see from the beginning of October to the third week, it kind of goes sideways, but then the third week of October tends to be the bottom for a nice move to the upside. Okay, now seasonality, you guys can argue, well, Dylan, seasonality tends to be bearish in September, yet the S&P closed up this month in a very, very strong manner. And I agree with you, right? This is just averages. Obviously, it doesn't happen every single year. This is just, historically speaking, what tends to happen. There's no guarantees in trading, but having some nice seasonality that goes along with the thesis can't hurt, right? So this is since 1928. This is on a monthly basis. You could see what I was just saying. The S&P tends to bounce, right? It tends to make that low towards the third week of October, and then from there on out, that's when it starts to rally into November, December for that Santa Claus rally. Okay, so if and when the S&P hits this trend line, if and when it ideally, I would love to see it coincide with that timing factor, which would give this boost, or give this thesis that nice extra boost. Okay, let's talk about something. So this is what it says, right? This is what Citadel said. On average, October 26th marks the Q4 low for the S&P 500, while October 27th marks the Q4 low for the NASDAQ 100. Late October dips typically precede the strongest trading stretch of the year. Okay, so that's kind of what I'm looking for going forward. What also lines up with Citadel's bullet points is the fact that Goldman's Cullen Morgan says, quote unquote, we see 93% in blackout, right? Corporate buyback, blackout, now with 95% by the end of the week. We estimate that the last day of this corporate buyback blackout window is October 24th. Okay, so basically, corporate buybacks come back into effect on October 24th or beyond October 24th, which also lines up with Citadel's October 26th and October 27th, where the S&P and the NASDAQ tend to mark the lows for that Q4. So again, this is just nice context that coincides. Okay. Also, we have this, right? These are some pieces of context that also align with that thesis, right? Seasonals flip positive into Q4. Positioning is still light, and hedge funds have degrossed Mag 7 exposure near cycle lows. I'll show you that picture, leaving room to re-risk. The setup argues for an early year-end rally, right? If we can just absorb some potential short-term further selling. Okay, so seasonality turns positive from now. That's what I basically just showed you. You could also see that the equity sentiment indicator, shows positioning is in light territory, right? This is bullish because, again, they use the word re-risk, right? If a lot of books, a lot of funds, a lot of different, funds and portfolios are underweight equities, right? It doesn't take much for them to either cover into that Q4, right, where that the seasonality tends to flip positive, right? They'll either front run into that, or it doesn't take much for them to basically chase the move higher, which adds fuel to the fire. Basically, I wouldn't say a short squeeze, but the same effect that a short squeeze would bring, right? So that's a good thing, right? This is what I was just reading before. Hedge funds slaughtering Mag 7 exposure. The hedge funds are the most underweight the Mag 7 names, right? These are your Nvidia, your Google, your Apple, right? The main magnificent 7 names that have been responsible for the vast majority of the rally since April. Hedge funds are the most underweight they've been in those names since before 2023, right? Since late 2022. So what does that do? It puts the possibility that these hedge funds need to chase that year-end rally to the upside, which fuels that market rally even more, right? And then there's some other stuff here, okay? But those were the main points that I wanted to show you guys. Also, another piece of that, right, that shows the positioning, right? Same idea. This is from September 26th, so 4 days ago, from the Deutsche Bank newsletter, right? Investor Positioning and Flows newsletter, right? You could see, despite the S&P going higher, right? That's the blue line. The asset managers and leverage funds continue to sell, right? So clearly they're very, very underweight. You could see here that the net futures contracts based on the CFTC COT report shows that leverage funds have been freaking selling since April, since Liberation Day. They've been selling the S&P 500, right? And they have a pretty hefty short position. I actually wrote here from JP Morgan, the S&P, the SPX short from leverage funds is the biggest short in 18 months. Okay, so very, very clearly put, there's a massive short position from leverage funds. Okay, so if and when this year-end rally does occur, guess what? Those folks are going to have to stop out of their leverage shorts because, leverage funds are the most vulnerable to liquidations, right? Because they're using margin, right? So if you have a massive short position in the S&P, right? SPX short is the biggest in 18 months. Guess what? That provides a lot of liquidity where if those liquidations occur, it could really fuel the fire to the upside. If that year-end rally occurs, right? Same deal with the Russell, right? Russell was short. I talked about this about 2 months ago, leading into a CPI about 2 months ago. The Russell was short big time, and I said, hey, this is setting up for a big short squeeze, which ended up happening. And you could see even beyond when that started, right? When that massive short squeeze happened, they haven't even gotten to that positive level, right? When I say positive level, they're still either short, right? Leverage funds are still short, and even asset managers are very underweight. Look at their weighting January of this year, right? In the beginning of the year, they were long, up here, right? Now they're very underweight the Russell, and again, leverage funds are very short. So again, this could turn into very bullish, chasing if that market does happen to rally for the next 2 months. And then the Nasdaq, they're the longest, but even still, the last what does this look like? The last couple months, they've been deleveraging. They were probably front running the negative seasonality from September, right? They were probably selling ahead of September, thinking that the seasonality would be poor. But here we are, very close to the all-time highs, and that seasonality pattern did not occur. Okay, so that's part of the reason. There's much more to it, but those are part of the reasons as to why I'm looking for an opportunity to buy that dip. So originally I was looking for a 3 to 5% pullback to buy the dip. I would still love that. Do I think it's going to happen? Yeah, I don't know. I really don't know. But if it does, that trend line on the S&P futures is where I start. I plan to start incrementally averaging into several names for that year-end rally. I'll give you one of them, right? Amazon's one of them. If and when the S&P gets down there, I will begin to buy Amazon on that dip, okay? And then I outlined a few others for the Academy, and I'll tell them the others if and when this does decide to, play out. To the upside, I really don't have much. Maybe next week's video, I'll have more context to the upside, but as of this moment, if the S&P and the Nasdaq take out all-time highs, I really don't have much up there. So again, I am ideally looking for a dip to occur, ideally down to that trend line, which lines up with right around 65.60 in the S&P futures. And if and when I do get that opportunity, I will scoop up several stocks for a year-end rally. Okay, so that's where my head's at. And if you guys have any questions, let me know. I always appreciate the support. And that's it. I'll talk to you guys soon. Peace.